going further out here, schedule number 21, that is what is called as trades, in this particular, I'm sorry, I think I left out. Yeah, non-current liabilities, schedule number 20. If I look at non-current liabilities, schedule number 20, further, I move to page number 229.
Ramkumar asked, in case of deferred tax, do companies have to pay extra like interest on the amount or any?
All that depends on the kind of what is called as your the subsidy what you are getting, or the kind of regulation what is being there, what is given by to you by the government. They might say subsidy, they might say there is going to be an interest, they will say there will be a simple interest, they might say there is no interest. It depends on what is called as the arrangement that basically comes along with the deferred tax in the process. Move to other liabilities out here. There is something called as deferred revenue. There is what is called as other liability, deferred revenue. What is this? Other liability and deferred revenue. Any reason? What is this? Other liability, it is there, and there is something called as deferred revenue.
Some payment you have not received yet.
Exactly opposite. See, somebody has paid you in advance. As of today, it is not a revenue because you have not delivered the goods to him. When you deliver the goods to him, it's a revenue. As of now, it is deferred. The revenue is not today. Revenue is deferred. Deferred is an English word. He said exactly the opposite of it. But good thinking. That's all. See, as of today, when does it become a revenue? When the transfer of the good takes place. As of now, the remittance has come. The car is still getting the last touches, final touches of painting, and it will be loaded onto the truck. Once it's loaded onto the truck, it is the dealer's responsibility. Till that time, it is your responsibility. Now, that what do you call it as the amount, it is not, you cannot convert it to revenue because I have still not loaded onto the truck. It is still in my yard. So it is my responsibility. It is not. So it is deferred. Revenue which is deferred in future. That is what is it. That is why it is a liability. Because supposing at that last minute the dealer decides to fold up and decides to call for the money back, you got to give the money back because it is not revenue. It is not shipped. Am I with you on this? So that is all what we call it as deferred revenue. Some people, some companies would term it, or some accountants would term it. I'll use the word accountant someone. Some accountants would term it as advance received from customers. They would write it as advance received on customers. They are very glorified. They will say deferred revenue. It at least looks very fancy, right? Both are there? One is we are only looking at non-current. Only looking at non-current out here. In this particular case, there could be what is called as why is it non-current? Now you will say then it should be current. Why is it non-current? I receive a deposit from my dealer, 10 lakhs, and I am going to say that this 10 lakhs I am going to adjust it over a period of next 5 years. And then I will retain the deposit from you at 1 lakh or whatever it is. The other 9 lakhs I am going to adjust it over a period of about 9 years or next 5 years or 7 years or whatever it is. Now, it is not going to get converted to a revenue right today. In a year's time, it is going to get converted over a period of time. That is why it becomes non-current. Am I with you on this? Any questions there? Now, I go back to page number 196. Go back to page number 196. Out here, we have finished everything which is non-current. That is, everything which is a long-term liability. As well as we have finished everything which is part of equity and debt part of it. Only barring one aspect which I said I will clarify as we go along. Now I move to the current liabilities. Current liabilities are there in schedule 16, 21, 17, that is borrowings, trades payable, other financial liabilities, and so on and so forth. You can go back, go to the schedules out there, starting from 16. Schedule 16 would be page number 25. Schedule 16 is page number 225. We saw the long-term part of it. There is also a current part of it. That is non-current, what is called as non-current term loans, and there is a current part of it. Loans repayable on demand from bank and cash credit and overdraft. What is this cash credit, overdraft, etc.? When we take a loan from a financial institution, from a bank, there are two forms. One is what we call it as long-term loan. Long-term for creating some kind of an asset out there, fixed asset. The other is what is called as short-term loan. In short-term loans, it could be your cash credit, overdraft, everything will come in, and that is predominantly for your working capital requirement. Let me re-stress that it is predominantly for only working capital requirement. When does a company get into financial, what is called as a financial trouble out there? You take a short-term loan and buy a long-term asset, then what happens? There is a problem because a short-term loan repayment will come in, and when short-term loan repayment comes in, then you don't have money, because when you take a short-term loan to finance working capital, that is what am I doing? I am buying raw material using the loan. Imagine buying for cash. Now I know it is for 2 months. In 2 months' time, I will use the raw material, convert it to a product and sell it and get the money, and when I get the money, I will repay it to that fellow from whom I have borrowed. What have I done? I have just used my working capital loan. Imagine I have borrowed money on a short term and bought a machinery. And then after 2 months I have to repay. The machinery has just started producing and has attained only what is called as what is steady state only now. Where is the money for me to repay? So then what do I get into? I get into this kind of a financial muddle out there. So what do? To repay that short-term loan, you will take one more short-term loan. And then the cycle goes on and on and on. Now, are you able to relate it to any event which happened in the last 1 year, which has been in news? Not you, sir. Not you. It was in the newspaper all over. Anybody putting on that? No, Kingfisher is old, yeah. Last 3 months, 4 months. Huh?
IL&FS.
Beautiful. Thank you. So what is it? If you look at IL&FS, that is why since he is a banker, I asked him to keep it because he would know that. Now, if you look at IL&FS, what happened? If you say, oh, IL&FS has gone bust and it's... No, it is not. Basically, the kind of assets what they have is huge. I am digressing from this, but give you a little more understanding of the whole thing. IL&FS is basically an infrastructure. For example, your roads, projects, bridges, etc. When you create a road project, the concession agreement is normally for about 20 to 30 years. We call it concession agreement because till that particular point of time, you operate. That is what is called as you do a BOT model or BOOT model. Build, operate, transfer, build, own, operate, transfer. So you build it, you collect toll. Imagine I put in 30,000 crores to create a road infrastructure from Chennai to, say, let us say, the next town out here, the Kanchipuram, including land acquisition, everything. Now, I collect toll on this. That toll, what I am going to collect is basically going to feed in for servicing my debt out there, as well as, when I say servicing, interest as well as repayment. So, I pay only 50 rupees or 100 rupees toll. How is it going to cover 30,000 crores? Like you, there are hundreds of thousands of fellows every day, right? Everybody is paying toll and the toll value is also increasing. So, principal is also slowly reducing, etc. So, now, and how long does it take? When you say concession agreement, it takes about 20 to 30 years for you to collect the money, repay the loan and pay the interest part of it. That entire closure happens at 20 or 30 years out there. So what happens? At the end of 30 years, till 30 years you operate, and after that there is a last T, BOT or BOOT. The T means transfer. After 30 years, I am not eligible to collect toll on this. I have recovered the money. I transfer this road basically to the government and then come out of it, and it's the government's property after that. With you on this? So far so clear? So, what happened in IL&FS? Long-term investment, long-term project, you are looking at a 30-year time period for you to recover the money, and basically financed by short-term. Short-term is not, in that case, short-term is not less than a year, but short-term is 4 years, 5 years, 8 years, whatever it is. That is short-term for them, for that kind of a project out there. So at the end of 5 years, when the repayment comes in, when the servicing comes in, there is no money out here because money is going to come over a period of 30 years out there. So that is what landed in the model. It is not that they didn't have assets. It is not that they were basically with doldrums. No, that it is not that. It is not. You cannot, somebody said Kingfisher, you cannot compare it with Kingfisher at all. It's an asset rich entity. But only thing is, your financing arrangement, there was a problem. You use the short term loans basically to finance a long term project out there. So matching is very, very essential. A classic example, that is the reason what I brought up. With you on this? So this current borrowing is always for working capital. For example, the sudden sum short requirement. Imagine on the 30th of a month you got to pay salaries to my employees. But I know on the 5th of the next month I am going to receive money on the sales what I made 2 months back. So what do? I need money for 5 days. When I need money for 5 days, I can do what is called as cash credit. I can do what is called as the overdraft. Overdraft means I draw more money than what is actually there in my account, etc. And so on and so forth. Am I with you on this? That is all what is called as current for meeting your working capital. Now, banks also term this entire thing into 2 parts. One is a term loan and then another is a overdraft facility out there. For example, based on your working capital requirement, the banks can sanction at the beginning of the financial year itself. Let us say, we sanction 10 crores. I'm sure he will be able to explain it better, but let me try and attempt to explain it. And let me say, 10 crore, they sanction as a loan to you, working capital loan. Part of it is term loan, working capital term loan, and other part of it is what we call it as a overdraft facility. And let us say 20% is overdraft facility out of the 10 crore. On that 20%, there is a small charge which is always charged to you. That is 1% or 2%, whatever is the number. I don't remember the exact number out there. There is a small percentage which is charged to you. That is, but you are eligible to borrow whenever you want that 20% money. That is, you can just borrow. You can borrow today and return it tomorrow. But the bank, why are they charging? They are making it available to you at any point of time during the working days of the bank. And when you borrow for that period, you pay a little higher interest for the amount what you have borrowed. The other part of it is term loan, 80% of it. You can take it, you can borrow it for 3 months, you borrow it for 6 months, for a fixed time period, fixed interest, you pay interest only when you basically borrow out there. Am I right, sir? Depends on the understanding of the bank. Because normally, for example, if you look at all the sugar mills, government sugar mills or cooperative sugar mills in the country, the kind of stock what they have as far as sugar mills are concerned is equal to about 8 to 9 months of production as of now. It was about a year's production, now it is up to about 8 or 9 months of production out there. And all of them are basically what is called as have cash credits. That is, their inventory is completely pledged and then the money is taken out there for them to meet their day-to-day operation. Every time they have to sell, they make an arrangement to sell, go and pay money, collect the advance and go and pay money to the bank will come and release the stock for them to be sold out there. That is what in that case happens in terms of cash credit, etc. With you on this? So far so clear? We move ahead. We go back out here to what is called as page number 100 we are continuing with this what do you call it as the borrowings of part is over. Then go to schedule number 17. You have all your financial liabilities payable to capital, creditors, interest, accrued, unpaid dividend, bank overdraft and other things. 1 second. Hold your question. Schedule number 17. This is all current liabilities. So various kinds of current liabilities that is there as of today. Yes, please. Yes, Pratik.
Sir, Malika asked, can you explain the header going by unsecured?
Secured, unsecured. Secured means what? Secured means you have a hold over a particular asset. Something is, as he said, you have something which is basically pledged out there. You have some inventory, something pledged. Unsecured, nothing. It's based on the relationship they are giving you. That is based on understanding what they basically give you out there. That is all the difference between secured and unsecured. Very simple. Am I with you on this? Schedule number 17. If you look at page number 226, you would see payables to cash, capital, creditors, interest accrued, but maybe interest accrued but not due. Imagine I have collected deposits from whatever. Corporates also collect deposits. You know that. Corporate deposit, you can also invest in corporates out there. You can invest in the form of corporate deposits. Imagine I invested in the corporate deposit. Interest payment happens on June 30th and December 31st. when I prepare the financial statement in the March 31st, interest accrued for 3 months, Jan, Feb, March. But is it due? It is not due. It is accrued. It's a liability for that 3 months. So that is what I would put out there. Interest which has accrued but not due. Possible. Unpaid dividend. Dividend declared but not paid. Dividend declared and paid, but that fellow has closed the account and then gone. The dividend is not credited, but I am still liable to pay him any day he comes back. There is a time period, there is regulations, etc., etc. We are not even getting into all that. Look at next one, schedule 18, provisions. Provisions, current part of it is there. What are the current part of the provisions out there? Employee retirement benefit. The fellow who is going to retire this particular year, financial year, I got to pay, short term. There are retirement benefits for employees, right? You might retire 20 years later or 30 years later, but somebody else might retire this year. So that part of that becomes what is called as current asset, entire thing. That is all what you basically see out here. 21 and 22, schedule 21 and 22. 20, 21 and 22. If you look at schedule 20, 21 and 22, the page number 229, there is what is called as other liabilities, advances from customers, deferred revenues or the statutory dues which you got to pay, statutory dues which you got to pay. Then you have what is called as trade payable. In trade payable, outstanding dues to micro, small and medium enterprises, outstanding due to creditors other than micro, small and medium enterprises. Payable, what you have to pay? What you have to pay? They have divided it into these. Some companies would divide it into trades payable, which are what is called as payable in foreign currency, payable in local currency. Some other companies can divide it into which are trades payable more than 6 months due, less than 6 months due. Anyway, you basically are you look at various annual reports, you will see these kind of differences out there. If you invoice it in the next financial year, it becomes a revenue for the next financial year. There is no point, because whenever you invoice, that is when it becomes a revenue. As of today, it is not a revenue. I don't even make a provision out there. Now there are schedule 22 is basically the current taxes, etc. I am not even getting into the current taxes part of it. I mean, current taxes in the sense, taxes is the liability which is basically current out there. Right? There are a couple of questions I have been getting. Let me try and address those questions. One of them said that, Baba, I think, yeah. He said that my company increased their authorized share capital to accommodate what is called as preferential right. No, it is not basically preferential. Please note, preferential shares is different. Preference shares is not part of your authorized capital. That is, they would have privately placed or what is called as your equity shares. They would have given a preferential equity shares to somebody out there. That is, I don't do a public issue. I privately place my what is called as my equity shares out there. You cannot have a preferential equity shares. That is not possible. Right? You can have multiple classes of equity shares. That is possible, but not very common in India. I think only Tata Motors has a dual class of equity shares. I am not even getting into that aspect as of now. I don't want to confuse. But all equity shares are the same. There is no preferential equity share. Preference shares are different. Equity shares are different. You increase the authorized capital to basically do a private placement. I want to give a preferential right to my promoters to pick up on equity shares and invest more money. That is what I basically would have done in that particular case. Am I with you on this? Now we move on out here. If we move on out here, I am moving to the asset side of the balance sheet. That is to the top portion of it. If we look at the asset side of the balance sheet, there is what is called as non-current assets. Some balance sheets will keep it as its page number 196, ma'am. Some of the annual reports will call it as fixed assets. Here it says non-current assets, anything, it's basically. If you look at property, plant, equipment, capital work in progress, intangible assets, I am going to stop at that. I am not, beyond that we will look at it a little later. This is what is called as property, plant, equipment. You don't know what is the value of each, what is the value at which it was bought, what is the depreciation per year, how much have you sold, etc. Now, you just look at schedule 4, page number 210. If you look at page number 210, it can be a little confusing. let us sort of try and understand that. Forget about the first part of the table, look at the second part of the table. The first part of the table, what does it give you? It just gives you that plant, property and equipment, consolidated figure is there. It just gives you a split up of each of those. That is, how much of it is in freehold land, how much of it is in leasehold land, how much of it is in building, how much of it is in plant and machinery, how much of it is in electronic data processing equipment, how much of it is in vehicles, etc. And please note, the vehicles mentioned here is not, for this is Maruti Udyog, not the vehicles which are finished goods stock. Please note, these are vehicles which are owned by the company for their own purposes. There is slight difference there. Now come to the second part of the table. Second part of the table is where the challenge is for you. When I say challenge is for you, leave the first 3 or 4 rows out there, move to what is called as the balance as of March 31st, 2017. 3-4 rows you can skip and look at balance as at March 31st, 2017. There is what is called as a freehold land, there is a leasehold land, there is a building, there is a plant and machinery, etc. All the aspects what you saw before are out here. Now, what is the addition that is made during that particular year? What is the disposal of adjustments? What is this adjustment? Adjustments could be because you are scrapping some things. Disposals and adjustments during the particular year out there. Then, what is the balance as of 31st March 2018? And that balance is what we call it as the gross value, the original value at which it was basically purchased. To that, you have what is called as accumulated depreciation. When you say accumulated depreciation part of it, you again leave the 3-4 rows and look at only depreciation expenditure for March 2017. That is balance as of March 31st, 2017. Out there was this was the balance as of March 31st, 2017 in depreciation head. Just look at that row. That is the accumulated depreciation on each of these particular fixed assets till 31st of March 2017. Am I with you on that? Now, I say depreciation for the year. That is what I am adding. That is for the year 17-18 because the balance sheet what we are looking at is for 17-18. Abdul, any problem? Which row are we looking at? There is what is called as, there is a head called as accumulated depreciation and impairment. In that, look at balance as of March 31st, 2017. That is charged on that particular asset till 2017 31st of March. The next row, immediate next row, any questions coming up? Please note. Immediate next row, yes please, you missed out.
No.
You're okay.
What would be the depreciation expense for leasehold land?
Which one?
There's a 5 million depreciation for leasehold land.
Oh, leasehold land can have depreciation, sir. Leasehold land can have depreciations in the sense of the kind of lease, it's a long-term 99-year lease, etc. And the building, part of the land could come with some kind of what is called as it could be maintained, it could be what is called as you could have a pathway out there and everything. There could be depreciation part of it. That is where it is very, very small in that way. It's not exactly huge. Now, depreciation expenditure for the year, that is depreciation expenditure for the year is there. Next out of it, after that, there is what is called as disposal or adjustments. What is this? Disposal or adjustments in depreciation. Imagine I have a particular asset out here.